Welcome to Armand Academy. Like and subscribe for more content and drop your doubts in the comments. Share with your friends and classmates. For private tuition in these subjects across all boards and universities, contact me here or the link in the description. Let's get started. When we think about expenditure in accounting, okay, it is broken up into two types. We have revenue expenditure, revenue expenditure, and similarly, we have capital, capital expenditure. When we think about revenue expenditure, when we think about revenue expenditure, what it involves is the day to day, okay, day to day expenses, day to day expenses incurred running a business or any organization, but any business. When we think about capital expenditure, it generally involves acquisition or purchase, if you want, acquisition of non-current, non-current assets. Right. So when we think about revenue expenditure, think about expenses, normal expenses. Let's say salary. Think about rent paid. Okay, you can think about legal fees. Okay, all those expenses that keep on happening again and again, or what we say are recurring expenses. More importantly, when you're paying salary to someone for the month, it is for the service that they provided in that month. Okay, and it is not into the future. We are not buying a human being. Okay, we cannot own humans, we can't own employees, but we can pay them a salary for their continued services. Okay, and we are paying them for the benefit in that period. Okay, so when we think about uh, capital expenditure, the benefit is beyond one period. Okay, beyond one period. And in accounting, when we think about this period, okay, we mean a single financial year. Okay, so when we think about capital expenditure, it is a non-recurring, non-recurring expense. Okay, rent is paid. Rent is paid monthly, month after month, year after year. Okay, and the benefit is is against that same period. Okay, so the rent paid for the whole year is because you've been using some property for that year. But if you are purchase of factory or office, this would be a capital expenditure where you can continue using that into the future. And what that does is it increases your capacity. Okay, because you purchased a new office or factory and therefore you're able to produce more goods and services. Right, so this is what we have in the case of expenditure. Now we are going to look at income. Okay, more than income, you can think about it as receipts. So expenditure money is going out. Okay, and in the case of receipts, money is coming in. And we'll have the same breakup. We have got revenue expenditure and capital expenditure. Similarly, we are going to have we are going to have what we can call revenue revenue receipts and capital and capital receipts. Now, capital expenditure is when you are purchasing a non-current asset such as land and building. Capital receipts is when you are selling sale of non-current assets or receipt of more capital investment. Okay, so if you are a company and you're selling shares and debentures or you're taking a loan, okay, those would count as capital receipts. But when we think about revenue receipts, it's the usual. Okay, as a business, you can invest in other businesses. If you invest in another company, you can have dividend received. All these are what you would call non-operating income. So dividend received, okay, RECIVEVED, dividend received, rent received, okay. You may have extra property which you put out on rent, that will be rent received. You have extra money, you put it in the bank, you're earning interest, okay, so interest received. So the interest on the fixed deposit will be interest received. Once the fixed deposit matures and the money goes back to your bank account, okay, that will be a capital receipt. Okay, what else would count as a revenue receipt? Any situation in the business where money is coming in. Okay, so uh, cash sales, for example, cash sales, receipts from debtors, all of these would count as revenue receipts. Okay, and the examples that I've given you for revenue receipts, capital receipts, revenue expenditure, capital expenditure are not the only ones that are out there. Okay, you have to think based on the definition of revenue expenditure, capital expenditure, revenue receipts, and capital receipts and decide what transaction would come under which category. Because at the end of the day, whatever you see happening in terms of capital expenditure, okay, capital expenditure means the item is going to go onto the asset side of the balance sheet. Revenue expenditure means the item is going to go either in the trading, okay, or profit and loss account. Profit and loss account. Okay, when we think about the revenue receipts, if it's going to be indirect incomes, all right, fine, it'll go on to the credit side of the P&L account. Okay, but remember, when we think about sales, the sales that are taking place, whether it is credit or cash, we put it anyway in the trading account credit side. Okay, but all these other receipts, okay, these are going to be adjustments that take place, okay, that take place in the cash or let's say entries that take place in the cash or bank account, okay, as well as the corresponding nominal accounts and personal accounts. Okay, similarly, when we think about capital receipts, this is not going to go directly in the balance sheet. Okay, what it would result in is a reduction in amounts in the balance sheet. Let's say if we sell some land, okay, so that much will be subtracted. The book value of that land will be subtracted. And then the gain or loss will go in the P&L account. And obviously, loss will go on the debit side, gain will go on the credit side, debit all expenses and losses, credit all incomes and gains. Okay, and that is for that very same reason that these indirect incomes go on the credit side of the P&L account. Okay, this is a short introduction. Next, we're going to be looking at a few slides to better understand what are these four categories of transactions. All right. So the theoretical framework has a unit dealing with capital and revenue expenditures and receipts. Okay, under that, we have a definition for revenue and capital expenditure. This is mostly from the study material, but I've made a few modifications in terms of grammar, as well as a few changes here and there where I felt there could be an improvement. These definitions, it will be very good if you memorize, okay, if you learn them as is, because most of the questions that come for this chapter is to classify the following transactions as revenue expenditure, capital expenditure, revenue receipt, capital receipt. Okay, and you have to say what it is and why. So, deciding what, you'll get, let's say, half the marks, and then why could be a repetition, okay, or a weaving in of the definition into your answer. Doing that, you are likely to get full marks. All right, so revenue expenditures, expenditure relating to the operations of the business in an accounting period or to the revenue earned during the period or the items of expenditure in order to maintain operational capacity. Again, this is important. Maintain operational capacity and whose benefits do not extend beyond that period. Okay, so that means you're spending money, you're spending money based on operations or running the business during a certain accounting period, not for multiple periods. If it is for multiple periods, then we will start looking at capital expenditure. Okay, but within the same period. And normally, what is this accounting period? This accounting period is normally a financial, a single financial year. Okay, and then we have in India financial year starting on 1st of April. Okay, on any given year to the 31st of 31st of March. Now, okay, and they're saying that it is expenditure relating to operations of a business in an accounting period or to revenue earned. So, in order to earn revenue, you need to spend money. All right, if you are running a restaurant, in order to earn money from your customers, you need to spend money on your chef, on your waiters, on the rent of the restaurant, on the food, on the ingredients in the food. Okay, think of your gas supply. All of that expenditure has to be incurred in order to prepare and serve customers. All right, so you're earning a revenue from the customer, but you're spending all of this money in order to be able to earn that revenue. And that's what they mean by expenditure relating to revenue earned during a certain period. Okay, all the items of expenditure in order to maintain operational capacity. If you are running a restaurant, okay, you will have ovens, you'll have gas stoves, okay, you'll have a kitchen that has to be maintained, okay, you'll have equipment that has to be maintained. All right, and that means you're going to incur certain expenses on regular repairs. Okay, you have to, in order to keep serving your customers, you have to keep paying the rent so that you have the space to accommodate those customers and to serve them. Okay, and by incurring all these expenditures, you're not increasing your capacity, you're just maintaining it at the same level as before. If you were to increase the capacity, then it is no longer revenue expenditure, it becomes capital expenditure. Okay, so capital expenditure is expenditure that generates enduring benefits by increasing operational capacity, thereby helping in revenue generation over more than one accounting period. Okay, so what happens if you lease another outlet? Okay, so you will end up paying more rent, that is fine, but you will end up spending a lot of money setting the place up. Alternatively, instead of renting, you could buy another outlet, set up another branch, own the property. By doing that, you will increase your capacity in terms of, okay, sticking to the restaurant example, how many customers you are catering to. Okay, you may end up being in more than one location, you're setting up a restaurant chain, one after the other you're opening up more restaurants. Okay, so whether or not you own the real estate, you still have to spend money on setting up the kitchen, on setting up the restaurant, buying furniture, and all of that is expenditure that results in benefits of more than a year, because you are not going to buy tables or you're not going to buy gas stoves and ovens every year. Once you buy it, it's going to be there with you for many years. All right. So you have enduring benefits more than a single accounting period or a single financial year. Next, expenses are recognized in the profit and loss account through the matching principle, which tells us, okay, the matching principle, which tells us when and how much of the expenses are to be charged against revenue. All right. So when we think about expenses to be charged against revenue. Let's say setting up, if you are setting up a restaurant, okay, in the month of January, and you're paying advance rent. Okay, if you're setting up in January, and you're paying advance rent for 6 months. Okay, keep in mind the year ends on 31st March. The year ends on 31st March. So if you have paid 6 lakhs, if you have paid 6 lakhs rent, okay, for 6 months, the amount that will go into the profit and loss account for the year ending 31st March will only be will only be 3 lakhs, because the remaining 3 lakhs will be for the months of April, May, and June of next year. Okay, so we will show it as a prepaid expense. All right, so that's what we mean by matching principle. We match the expenses against the revenue, okay, in the period in which they take place. Expenditure can be capitalized only if they can be traced directly to definable streams of future benefits. Okay, even in our case where we have prepaid rent, that is not a form of capitalization. Okay, we are still following. Okay, we are still following what you can call, we would still consider it revenue expenditure because the benefit is still within a year, even though it may span across 2 financial years. We have just paid for 6 months. All right. So whenever we're making payments for more than a year, okay, for more than a year, but it is still revenue in nature. Okay, we have a separate topic which surprisingly is not part of your syllabus. Okay, which we call deferred revenue expenditure, which is something that is otherwise expenditure, but because it is written off over multiple financial years, okay, we show it on the asset side. We show it as on the asset side, but it is a large expense already paid. Large expense already paid. Okay, and even in the case of prepaid rent across 6 months, it won't even count. But, but if you purchase purchase office space, okay, or purchase commercial property, office space, a shop, okay, whatever, premises, okay, you can think about another better word would be premises. When you're purchasing it, you're going to be able to serve more customers in going into the future, and therefore definable streams of future benefits. Distinguishing transactions into revenue and capital is done to determine their inclusion in the profit and loss account or in the balance sheet. And this I've explained in our introduction. Okay, so obviously, revenue items, okay, will go in the profit and loss account. Revenue expenditure will go in the profit and loss account. Capital expenditure will go in the balance sheet. Next, we have revenue. As I said, revenue expenditures are shown in the profit and loss account as their benefits are for one accounting period in which they incurred. Capital expenditures are placed on the asset side of the balance sheet as they will generate benefits for more than one accounting period. They are transferred to profit and loss account, okay, of the year on the basis of utilization of that benefit. Now, if I was to buy a machine, okay, if I was to buy a machine, okay, whatever, let's say a coffee machine. If I bought a coffee machine, which is going to last for 5 years and the cost is 50,000, then maybe I should be putting 10,000 because it is for 5 years. Okay, I could perhaps put 10,000 in the PNL account every year, in the PNL account every year. Okay, and we have another chapter which is for depreciation. Okay, but depreciation itself is what we are calling a write-off. We are writing off or depreciating a asset over a period of time, where the balance of that asset in the balance sheet will keep on reducing as we transfer some amount every year to the profit and loss account as depreciation. Okay, but we don't just have depreciation, we have amortization. We have got many other instances where uh, items in the balance sheet keep on reducing. Okay, and that is normal. So that means in the long term, what happens? Both capital and revenue expenditure one day will end up going to the profit and loss account. What is different? Okay, what distinguishes them is simply time. Now, revenue expenditures are transferred to the profit and loss account in the year of spending. Capital expenditures are transferred to the profit and loss account in the year in which the benefits are utilized. So, if you're using a machine over 5 years, then you will transfer the balance of the machine from the balance sheet asset side to the P&L account debit side over those 5 years. And we've got different methods. Okay, what I did over here is I'm putting 10,000 every year, which is called the fixed installment method. Okay, but you also have the reducing balance method where it is percentage based. You've got machine arm method. You've got different ways in which you can do it. But at the end of the day, that capital expenditure does get transferred to the profit and loss account. Okay, as I mentioned before, time is the main determinant in deciding whether it is going to be a profit and loss account or whether it's going to be balance sheet. So if it's going to be used in a single year, okay, it will go in the profit and loss account directly. If it is going to be used over multiple years, it will first be kept on the balance sheet asset side and then slowly transferred. Now, expenses are recognized in the profit and loss account through the matching concept. We have already discussed this before. The same point has come up again, which tells us when and how much of expenses are to be charged against revenue. Now, how do we decide whether something is going to be a capital or a revenue expenditure? So, first is the nature of the business. For an ordinary business, for an ordinary business, furniture, okay, furniture, furniture, okay, and okay, furniture is a capital expenditure. Why capital expenditure? Because I'm not buying the furniture to sell further. I'm using it in my business. Okay, if I'm running a retail store, I'm buying furniture so that I can use it as part of my business. I'm going to be putting all the products on display on these shelves and I'm buying those shelves. Okay, but if I'm running a furniture business, okay, for a furniture business, I am buying that furniture to sell. And that means I'm going to get the benefit in the same year. And that means it will be considered a revenue expenditure. Okay. And right. Yes, I know my handwriting is a little, I mean, I'm sure you will understand. Now, revenue expenditure, furniture is a revenue expenditure, purchase of furniture is a revenue expenditure for a furniture business, but it's a capital expenditure for all other businesses. Okay. Property. Okay, construction, if you think about construction of residential property, if it is done by, or even office property, construction of office property by a business that is constructing it for its own use, it will be capital expenditure. If it is done by a real estate company that is constructing it as part of its business in order to sell to others, okay, then it is going to be revenue expenditure. Recurring nature of the expenditure. Okay, so if it is non-recurring, okay, it's a one-time, non-recurring, one time, usually large expense, then it's going to be capital. If it is going to be recurring, then it is going to be revenue expenditure. All right. Purpose of the expense. In order to decide whether an expense is capital or revenue in nature, okay, you need to think about what is the impact. Okay, what is the impact on the future income generating capacity of the organization of the business. All right, so when we think about repairs, okay, and when if you look at the content, the example that is being used is repairs. Okay, so if you're repairing, okay, when repairs are done in order to restore to original capacity. Okay, you bought a whole bunch of machines. Over a period of time, their output keeps on reducing because they need maintenance and repairs. And when you are doing repairs and it goes back to the original capacity as before, then we would call it revenue expenditure. However, if the repairs involve increasing the capacity, okay, if capacity increases, right? If capacity capacity increases increases, that means the same. You think about the machine. If you're able to make changes to the machine, upgrade parts of the machine because of which it is able to produce more, you can say, output than before. If the output increases, capacity increases, then it would be considered capital expenditure. Okay, and I mean, we are calling it capital expenditure, but remember, in higher level finance, you hear the word capex. Okay, capex is capital expenditure, opex is operating expenditure, very similar to what we call revenue expenditure. Anyway, effect on revenue generating capacity. If the capacity stays the same, if it stays the same, it is revenue. Okay, if it increases, it is capital. Simple. Next, materiality of the amount involved. If it is a large amount, okay, then it would normally be capital expenditure. But if it is a small amount, then it would be revenue expenditure. And a lot of times, what will end up happening is it could be a item which is going to be with you for many years. If you think of a calculator, okay, so if you think about something like a calculator, you're running a multi-crore business. This calculator is hardly costing you rupees 500. Okay, I mean, all of you are preparing for your CA foundation, or whichever exam. I remember when I wrote my CA entrance. Okay, the calculator which I used, I continued using it all the way up till intermediate. Okay, and all the way through degree college. Right, I used to consider the calculator my favorite calculator, and maybe 5 years I use a calculator. But in businesses, what ends up happening is these small expenses, okay, small expenses, even though it's going to be with you for many years, all right, we simply expense it, we show it as revenue expenditure. All right, so if you are running a small business, should you show it as capital expenditure? At the end of the day, it boils down to you, there is some amount of subjectivity in terms of what the accountant would do. Okay, but generally for such small expenses, it would be expensed and shown as revenue expenditure only. Okay, think of it like this. You buy a sharpener for 2 rupees. Sharpener for 2 rupees. That sharpener is going to be with you for many years. Are you going to show it as an asset and depreciate it every year? Just show it as an expense and finish it off. All right, and that is what we mean by materiality of the amount involved. If it is a large amount, it is material and therefore capital expenditure. If it is a small amount, it is immaterial. Immaterial. And therefore, we treat it as revenue expenditure. Next, we have capital receipts and revenue receipts. Capital receipts are receipts which are not revenue in nature. Okay. And examples include sale of fixed assets, sale of investments, secured or unsecured loans taken, owner's contribution. When we think about owner's contribution in the case of a sole proprietorship, it is the proprietor investing more money or resources into the business, or it could be a partner. In the case of a company, okay, in the case of a company, it would be issuing shares, issuing shares. It could be issuing debentures, okay, which is a form of borrowing by companies. All right. So what's happening as far as the business is concerned? Money is coming in, but it is not part of the day-to-day running of the business. It is normally a one-time capital infusion or loan being taken. All right. So when you think about capital expenditure, in the case of capital expenditure, we are buying or acquiring fixed assets. Capital receipts will happen when we are selling those fixed assets. Okay, if you were to, as a business, buy property or make investments, okay, at that point of time, money is going out, it will be capital expenditure. But when you're selling that property or investments, it will be a capital receipt. You could open a fixed deposit with the bank and you're earning interest over a period of time. When you open that fixed deposit, as far as you're concerned, money is going out. It's a capital expenditure. Okay. But when that deposit matures and you're getting the money back, it's a capital receipt. Okay. So fixed deposit with the bank at the end of the day is when you are lending money to the bank. That time it is capital expenditure. If the bank lends money to you, it is a capital receipt. Okay. Now, revenue receipt is receipts which are obtained in course of normal business activities. Okay, so all of the normal stuff you could imagine. They mentioned interest income. It could be dividend. Okay, it could be dividend. It could be rent. Okay, all of this received. Okay, dividend received, rent received. Okay, when we are selling goods, we are doing cash sales. So we get the money on the spot, or we sell it on credit to our customers. They become our debtors. And when they pay us that money, okay, what we call receipts from debtors, that would be a revenue receipt. Okay, so any doubts, feel free to ask. With that, we are done with the section on capital and revenue expenditures and receipts.